Good afternoon, ladies and gentlemen. Welcome back to the 9th of June weekly market review. So far, we are in the second week of June already. And we have Gerald with us today. How are you, Gerald?
Hi everyone. Very well. Like Sunny mentioned, in the second week of June, understand it is the school holidays. So we are seeing quieter market activity, but still then there's quite a bit of movement because of uncertainty towards the trade policy, as well as some news around changes to the STI.
Yes, talking about developing things in the market, I think last week we saw that a very dramatic fallout between Elon Musk and Donald Trump, which caused the index, especially tech counters, to react a bit with Tesla down 14%. And then we also have some developments on the trade talks that China or Beijing and Washington are having a discussion this week. And investors are keenly waiting for the outcome of this trade talk discussion to see where the market will head. But latest news that I see this morning, trade talks with US and India is going well and has been extended. So that could be a positive sign. And of course, last Friday, we have that non-farm payroll data, which shows that US economy is still going strong. Hence, that's why maybe the US markets has been performing quite well for the last week. So I think with all the developments here, I'll let Gerald take us through some of the key points.
Sure. Okay, starting with some disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google, either by scanning the QR code or going to this website. And if you'd like to join SIAS as a member, where you can access various online resources and investor education programs, you can go to sias.org.sg/membership. So in the past week, we actually saw fairly strong performance across various markets. The S&P 500 was up by 1.5% and the STI was up by 1%. Okay, so most of the developments around the trade tariffs were still fairly positive, even though there were a lot of various developments and news flow that came through the week. To me, the most significant one is the Trump comment that the talks with China were progressing well. So that actually helped to ease some of the market tensions and concerns on whether we will see an escalation in the trade war. In terms of the economic data, the key one that came out last week that we were looking out for is the US non-farm payroll data. What we see here in terms of the May data is that it remains fairly healthy and actually above market expectations. So while we see some signs of slowing down compared to the month of April, that is fairly limited. And even though there has been a lot of uncertainty towards the trade war that started in April, we see that overall the US labor market remains healthy. So with the jobs data that came out, we see that investors have moderated their expectations of rate cuts. We also see a bounce in the US government bond yields. Based on what I see here, the US 10-year government bond yield is now back up to above 4.5%. So that is something that I'll continue to keep a lookout for to see whether or not there is a continued increase in the US government bond yields. In the Singapore market, we saw earlier that the STI actually improved together with the better sentiment towards the global markets. We see here a few names that had fairly sizable gains, particularly the property counters. City Developments up 8.5%, UL 7%, Hong Kong Land 5.6%, and Keppel Corp 5.3%. So this is also driven by the news flow around City Developments, where they are selling a stake in South Beach. In terms of the worst performers, we see some of the Jardine-related names, DFI Retail Group, Jardine Cycle and Carriage, Jardine Matheson, actually in the list of the worst performers. And some of the REITs as well, CapitaLand Ascendas REIT, that I spoke about in last week's weekly market review. So in the Singapore market, we saw the announcement of the Straits Times Index quarterly review for June 2025. So with the announcement that Keppel DC REIT will be included in the STI and Jardine Cycle and Carriage will be removed from the STI. So if you're not familiar with the STI, it is a benchmark for the Singapore market with 30 of the largest and most liquid names in the Singapore market. Okay, so we actually see Keppel DC REIT being one of the more resilient REITs in the market. Effectively, after the sell-off with the trade tensions, the share price of Keppel DC REIT has recovered and is now actually above where it was prior to the announcement of the trade tariffs. So given that we see some of the REITs facing headwinds, Keppel DC REIT is actually one of the better performing REITs, and its share price has been lifted by some of the acquisitions that it has done as well. Okay, so what we see here for Keppel DC REIT, asset under management of close to 5 billion as of December 2024. This is made up of 25 assets across Asia Pacific and Europe. And what we see here is that the assets under management has grown fairly strongly from its listing in 2014, when it was at about 1 billion to 5 billion as of 2024. So that represents a compounded annual growth rate of 17%, and that has also helped to support the share price of Keppel DC REIT. Okay, so in terms of the portfolio breakdown, we see here Asia Pacific is where the bulk of its assets are, representing 80.7%. And Singapore would be where a lot of these assets are, and that would represent 65% of its entire portfolio. The remaining 20% of assets are in Europe, where it has got data center assets in Germany, Ireland, the Netherlands, UK, as well as in Italy. So if I were to look at the distributions for Keppel DC REIT in 2024, they actually saw an improvement in the distribution per unit to 9.504 cents. And that is a 1.3% increase from 2023. Overall, we see that the gross revenue went up, the net property income went up, and even with the increase in finance costs, the distributable income actually went up. Looking at the most recent first quarter numbers, the improvement in the distribution per unit continued, and we actually see a much sharper increase in the distribution per unit by 14.2%, and that is driven by the acquisition of 2 data centers that was completed late last year. Okay, so these are 2 data center assets in Singapore, KDC SGP 7, KDC SGP 8. They are AI-ready data centers and 100% contracted to global hyperscalers. So examples of hyperscalers would be, say, AWS, Microsoft. They'll be running some of these services to provide cloud service to customers. Okay, so in terms of the rationale of the acquisition that they provided at that point in time, it actually increases its exposure in the data center market in Singapore, which is Asia's top data center hub. It was expected to be immediately accretive to the distribution per unit, and what we see already is the improvement in DPU in the first quarter of this year. In addition, the REIT manager expects that the acquisition can help to drive further growth when the rents are renewed, given that the current rents are below the market rates. Okay, so this was the expected improvement to the distribution per unit that was expected by the REIT manager, assuming a land lease title of 15.5 years, and without tax transparency, it was expected to lift the distribution per unit by 11%. I mentioned earlier that the REIT manager expects that there's potential for rental uplift, and that's because based on the current rents, they are estimated to be at least 15% to 20% below comparable rents in the market, and that is why the REIT manager is confident about potential uplift to the rents when they are renewed. Okay, so overall, we see that for Keppel DC REIT, the portfolio occupancy is high at 96.5%. They also managed to get positive rental reversion of 7% in the first quarter of 2025. What is driving this high occupancy rate and positive rental reversions? Overall, we see that while there's some new supply in data centers in the Singapore market in the coming years, they have actually all been pre-leased and reflecting the very high demand for data center assets. And overall, we see that for the utilization rate of data center assets in Singapore, they are close to 100%, and that once again reflects the very strong demand. If I were to look at Keppel DC REIT's balance sheet, aggregate leverage of 30.2% after the equity fundraising that they did to be able to fund the acquisitions. So that still leaves further headroom for them to make further acquisitions. Interest coverage ratio of 5.8 times. So once again, that is something that is very healthy. If I were to look at the valuation of Keppel DC REIT at this point in time, the price to book valuation is above the sector average. And that is probably a reflection of the ability of the REIT to be able to grow its distributions. If I were to look at the dividend yield, if I look at the historical dividend yield, based on what it paid out in 2024, looking at the dividend yield of about 4%, with the accretive acquisition that was made, that can potentially be higher, but that would still put Keppel DC REIT's current dividend yield to be below the sector average. Okay, so that is a sharing on Keppel DC REIT based on the news that will be included in the Straits Times Index. For this week, we are a bit quiet in terms of the news flow. The key economic data point will be the US consumer price data that I'll be keeping a lookout for. But other than that, there's no major earnings to keep a lookout for. So I believe the market will continue to be driven by the trade war news as well as the inflation data. Okay, so with that, I hand over to Sunny, who will share the technical analysis.
Hey, thanks, Gerald, for the update on the Singapore market. Great to see that Keppel DC REIT is going to be included in the STI index. That will give them more visibility and exposure to investors, especially institutional investors that are tracking the STI index would have to buy into Keppel DC REIT now. So that could signify that REITs in the second half of the year recovery could continue to become better. Okay. So on that note, let me touch on the STI index first. So for the week, STI index rose about 1%, as what Gerald shared earlier. So that is a positive development. And also on top of that, some of the trade talk development has been progressing well. Hence, the STI actually sort of right up that wave as well. Okay. So from the technical indicators, looking at the STI index, we are now at 3,938 points with the high at the 4,005 points. So we are just about 70 points away from that level. So market is for the past 2 weeks or so, as you can see from the MACD indicator, has been very range-bound trading. We are still lacking any big catalyst that may be coming through to push us towards the all-time high at 4,000 level. One of the catalysts that could be the trade talks between US and China this week as we count down towards the 9th of July. Tariff developments or the pause of the tariffs will end on 9th of July. So that is something, the date that we need to take note of. So MACD indicating that we are likely going to move sideways with some positive news coming in. So there's a slight positive upside on the STI index. The Bollinger Band has also sort of converged together and narrowed into a very narrow range of trading. Hence, it also indicate what we call a Bollinger Band squeeze and a breakout a chance of a breakout, whether it's on the upside or downside, would be a very high possibility soon, just like what we observed earlier part of the year over here. So that breakup or breakdown would likely be the outcome of the trade talks that's happening right now between US and China. On the RSI, we have also seen the latest reading at 65 is still a very healthy reading below the 70-point overbought level. Hence, there is still some headroom for the STI to go slightly higher. So I would say of the STI index, we still have a slight optimism of it trending higher towards the previous high that we saw, which is the high on 13th of May at 3,956 points. So that is a very narrow headroom ahead to look out for in the coming few weeks. Okay. Next, let me move to the US indices. So US indices also performed quite well. Let me do a summary of what are the key events that happened last week on the US side of things. At the beginning part of the week, we had some accusation flying between Washington and Beijing. US was saying that China was not fulfilling its sort of a promise in the tariff pause, where they sort of did not accelerate the export of rare earth to US, which is a critical component for some of their major industry, especially the manufacturing of EV and some electronics over there. So that is what Donald Trump is complaining about or accusing China of. And China on the other side also says that US did not keep to its promise on the trade tariff pause, where it also stopped some of the students from going into the Harvard University, as well as banning some of the AI chips to China and some of the chip design software as well. So both sides are having talk this week. Donald Trump said to us on Thursday, I believe, that he had a call with the Chinese leader, Xi Jinping, and trade talks were going well according to what he said. But as an analyst, I want to look for more concrete answers, and so far I have found none. So the rare earth issue is still a problem. The chips issue, chips export to China is also still a problem, which remains unresolved. So I would look out for this slightly more technical details from this week trade talks between US and China. Okay. So some of the most prominent gain also came on Friday, which is the jobs non-farm payroll data. And that data actually pushed the Dow Jones index up above the red color line, which is the 200 days moving average. So all three US indices has cleared this major resistance level, major long-term moving average, and is now above that level. So that could mean that the bottom out or the rebound is already confirmed, and we could be on our way back to target the year-to-date high or the all-time high for the Dow Jones index is at 45,054 points. That is this year high, and previous year high was at 45,073 points. So that is the target that we are looking at. And for the Dow Jones index, we are still about 2,500 points away from that level. So that could, for the second half of the year, I would see two catalysts. One is the resolution of the trade tariffs, and the other one will be the rate cut coming in the second half of the year that will push the major index up higher. So looking at the nearer term, we can see that the Bollinger Band on the Dow Jones Index is also starting to converge, and hence the trading activity for the past 1 week or 2 weeks or so is also in a very tight range. So that means that it's not going into any big direction. Okay, and if you look at the MACD, that is also confirming what we observed in the past 2 weeks at least. So this converging of the Bollinger Band, right, could signify a potential breakout, just like what we see on the STI index. And a lot of investors and market watchers are now waiting for the results of the trade negotiation before planning the next move. On the RSI side, we see that the Dow Jones Index is at 60 points, which is a healthy reading, 10 points above the 50-point neutral mark, 10 points below the 70-point overbought level. So that means that the uptrend of what we see since the bottoming out in April would likely continue. And key resistance level now that we are looking at, we have sort of tested this high on 26th or 24th March. And then now, of course, we are going to target the next high, which is the year-to-date high at 45,073 points. Okay, so that is the level that we are looking at. Next, let me move to the broader index, the S&P 500. So S&P 500 has also recovered quite well, and you can see that we did test the 200 days moving average somewhere on the end of May period, and then we had a convincing rebound, thereby signaling that, hey, there is a lot of support at the long-term moving average, the 200 days moving average. Should it come back down to test this level, that some technical buyers will come in, as well as further support coming in from the lower bound of the Bollinger Band as well. So these are the key support levels for the S&P 500, being at the 6,000 level now, which we managed to close last Friday. We are now just about 147 points away from the all-time high of the S&P 500, where we see in the February of this year. Okay, so looking at some key major movement last week, still pretty flat. Market is not too concerned on some of the comments made by Trump, I would say. We have come a long way since the April announcement of the trade tariffs, and market seems to not be bothered by, I would say, unconcerned by some of the tantrum that Trump has been showing or accusing China of, and eventually, like what the Financial Times have coined, Trump always chicken out at the end of the negotiation and sort of come to a compromise for a trade deal that is more sustainable for all the other nations. Okay, so S&P 500 likely will have a chance to retest the high this year towards the second half of the year. And then on the support side, the 200 days moving average and the lower bound of the Bollinger Band at 5796, or I will round it off to the 5,800 level, would be the key support, with the 200 days moving average here as the support for the S&P 500 index. Lastly, let's move to the tech-heavy index, which suffered a little scare because Tesla was dropped 14% on Thursday night. So because of the fallout between him and Donald Trump, and there was also Elon Musk himself saying that he might want to support the Democrats. So that could, I don't know, throw more uncertainty into the political environment of the US. But nonetheless, you can see that the rebound from the low of April among the US indices, the NASDAQ rebound was the strongest. So you can see the NASDAQ index now at the 19,318 points is just 700 points away from the all-time high of 20,200 level. So that is a very possible kind of a scenario. So if we have a positive development from the trade talks coming through this week, NASDAQ Composite Index could come in to trend around this region over here. Okay, which is the period that we saw at the beginning of the year. You can see that when we touched this high in December last year, market sort of trended around this region, okay, using that support of the November 8 high, somewhere around the 19,400 points level, and then up towards the 20,200 point level. On the support wise, you can see these three lines converging over here. That is the 200 days MA, 100 days MA, and the lower bound of the Bollinger Band. That will provide a lot of support for the NASDAQ Composite Index. Okay, so this level to watch will be the 18,500 points level, which is where the 200-day MA is, and the lower bound of the Bollinger Band, and the 100 days MA at the 18,400 points level. So I would say this would be the accumulation zone for the NASDAQ Composite Index. So as usual, past 2 weeks has been a sort of a range bound kind of a movement. So that could means a stabilization of the uptrend that we see so far. And we are looking for the next catalyst to see where the index will go going forward. And we have to take note of the RSI index, which is just now 4 points away from the overbought level. And once it hits that level, probably it will be good to sort of take some profit off the table. And if I'm going to scroll back, when we touched this level, that was the high that we saw in December last year. And if we touch the 20,000 level, then we have to be careful and see whether we want to lock in some of the profit at that point of time. Okay, and this is all that I have to share today. And next week, we are looking forward to the CPI index. So besides that, anything else that we need to track, Gerald?
Yes, it's really the consumer price index data. And given that a lot of the uncertainty around the trade tariffs is still there, I'll still continue to keep a lookout around what Trump says and how the negotiations with China actually go.
Yes, I think that really sums up what we are looking for next week. So Trump tariff talks is the thing to watch out for, and we hope that the CPI data doesn't run away too high, and that means that we have a better chance of seeing a rate cut in the second half of this year. That could be the catalyst for the markets to go another leg up higher. So stay tuned to all this development, and we'll update you again next week in the next weekly market review. So in the moment, just trade safe and stay safe and wait for further developments. So thank you and goodbye.
Thank you.